Hello again. Right, okay, I want to tackle a subject here people have tweeted about a few times, saying that technical analysis is a waste of time, it's hopeless, it's useless, and fundamentals are the only thing that really matters when it comes to trading. Absolute garbage, and I'll tell you why. Here we have a chart of gold. Some people say that the precious metals markets are manipulated so that any kind of trading on a chart, technical trading, again, is a waste of time. Absolute rubbish. Manipulation, I don't, yeah, of course manipulation happens. We know manipulation happens. It happens in all the markets, not just gold, not just silver, but right the way across commodities markets and also equities markets, general equities. There's all sorts of insider trading that takes place, all sorts of manipulation. Trades are made to stop people out of their positions and to force capitulation, all sorts of that. We know that there's nothing new about that. But to try and say that that means that technical analysis is a waste of time, it doesn't work, right? I'm going to show you now that that's completely wrong. So history has shown that markets have a cyclical behavior and a cyclical nature to them, and those cycles are repetitious and predictable. The gold cycle, as it turns out, is an 8-year cycle, and the 8-year cycle is measured from low to low, not high to high, but from low to low. So you identify the low point in the cycle and you start the cycle there, and then you identify the next low point in the cycle, depending which time scale you're looking at, but I'm looking at a time scale of years here, not the monthly and weekly cycles. So you can identify broad cyclical behavior, and this goes back off to the left of my chart here, back in time, and it does for the US dollar and other markets as well. In fact, in the case of the US dollar, the cycles were the cycles as we know them now began really in the 1970s when the gold standard was abandoned and the US dollar settled into a repetitious, predictable cycle, as I say. And here we have it for the gold market, 8-year cycle with an overlaying 16-year cycle, made up of two 8-year cycles, obviously. So you have a low here, around about 2000, 2001. Next one here in the 2008 sell-off. Next one here in 2016. And so the next one's going to be in 2023, 2024, late 2023, early 2024. So that gives you the background and the backdrop to the overall direction of travel for the market. It goes up during the cycle, and then it comes down into its cycle low. Then it goes up during the cycle and down into the cycle low, up into the cycle, and then down into the cycle low. What you can't say with a huge amount of certainty necessarily is at what point during the up part of the cycle you then begin to come down, because in a weak market, a downtrending market, a bear market, an overall bear market, what happens is that the price goes up during the up part of the cycle, but generally quite weakly, without any strength, and then the price will start to drop quite early in the cycle, and it'll drop way down into the cycle low before picking up again. And that tends to happen in a bear market where the cycles are left translated, which means they only go up a little bit and they go down a lot. They go up a little bit, then down a lot. So the overall direction in time is down. The opposite is the case in a bull market. And you could say that we've been in the bull market since the year sort of 2000, because you can draw a straight line that goes all the way from the bottom left all the way to the top right. If I can get the software to even draw a straight line for me, there we go. So that is the direction of travel. It's up, so it's a bear market. It depends on your timeline, because if you're talking about bull markets and bear markets, you have to define your timeline. If you're talking about a timeline of a couple of decades, then that's a bull market. But you can break that down into a bull market here up until 2008, a very short bear market down into the 2008 lows, which went there, and then bull market resumed. It took us up to the highs in 2011, and so on. Obviously down into the bear market lows in 2016, and then we're back up to where we are now, like that. Okay, so effectively you've got a bullish trend, a bearish trend, a bullish trend, a bearish trend, a bullish trend, but the overall pattern is upwards. Okay, so that's all useful information to know, and that gives you the background to the overall picture. If you're investing in a market, first thing to know is the overall trend, the prevailing trend, up or is it down? If it's up, then things are a lot safer for trading in and out of in an uptrending market than they are in a downtrending market, because any mistakes that you made will be compensated for by the next surge in price. Okay, so quite some time ago, back in, well, not that long ago, I suppose in 2019, I'd been tracking the breakout from this 2016 low, and I'd been posting various places that, you know, that was the bottom, and I think quite a few people spotted and were calling that as a bottom. Of course, we went up into the middle of 2016 and came back very sharply, and people started to panic again. But I certainly didn't, because we're in this overall bull market, which is going to take price upwards, and of course it did. And following the breakout that took place, well, there were a couple of points that I made a very clear call at the time, and I'm not the only one to do this. I'm not saying that I was the only one, because this is fairly obvious, simple technical analysis. You can draw in your resistance line at the time that was capping the price somewhere around about $1,400 or just below. Price kind of came up to that and then was rejected, and then it went back up into that zone again and was rejected, and eventually broke through it in the middle of 2019. So that was one point where it became clear to me that we could see what I call, and many others call, a reverse symmetry move, where you very simply sort of repeat what happened on the way down. So because price moved so rapidly down into that cyclical low, eventually down into 2016, because price moves so rapidly downwards, then there is much less resistance when you go back up. So it becomes, okay, my arrows all over the place here, it becomes quite easy for price to reverse back upwards with minimal resistance. Got too many arrowheads on here. I'll try and delete the right one if I can, just to make things clear. Is it that one? No, of course it wasn't. There's the other one. Okay, here we go. Okay, so price reverses rapidly upwards and took us back towards that 1800 level, at which point that was another significant breakout point here. So that's one reason why everybody's been keeping an eye on the 1800 level, because that was a significant breakout point. So this current correction could very easily, and has every right in going all the way back down to the 1800 level to test that breakout. So, you know, that's the theory in terms of textbook chart action, would be to see price come down and then accelerate away upwards to the upside. But there's nothing that says we have to do that, because in a strong bull market, upside surprises are more common than any sort of downside reaction. Sorry, I'm just taking a sip of my cup of tea here. So that's where we find ourselves at the moment. What I'm going to do here is just demonstrate one of the calls that I made, and try and sort of prove in a way that saying that technical analysis is no good is just plain wrong. So bear with me a moment. Okay. Right, so as I've just try and see if bringing that to front makes any difference. To front. Right. Okay, so when this happened in real time, obviously we've got no idea where price is going to go over the coming sort of days and weeks. So I've just blacked out this whole zone here, trying to get you in the mindset that we don't know what's happening next. If you study technical chart analysis trading patterns, you'll learn that when you get a movement upwards, what happens next, the pattern that is formed after that up move, gives you a lot of clues as to whether it's going to break out upwards or downwards. This one here, let's try and zoom in a little bit. In fact, I don't want an arrow on there. In fact, if I just switch to the 1 year view and go back a little bit, I don't think that's going to work, is it? I'll try the 5 year view. No, that's not working either. Okay, I'll go back to where I was. Okay, I tried. So price has been moving upwards since late 2018, and we got this sharp move that went upwards from here to here. Hopefully you can see that okay. Not easy doing this in real time whilst I'm talking, and you can also see that there's a smaller up move there. So what I'm talking about is, perhaps if I highlight it this way using that tool, what happened is that the price, and if you zoom in like I was trying to a moment ago, this is a lot clearer, of course. Price formed a flag, and the flag was trending downwards, and a downtrending flag is a very bullish pattern. It's a consolidation pattern. It's indicative of a trading range that is going to break out to the upside. And the same thing happened there. So when I saw that flag, it was a simple statement to say, well, the moment the flag breaks to the upside, we're going to get a significant move upwards. And the measured move starts at the bottom of the flagpole at about 1300, and the top of the flagpole is about 1550, shall we say. So that's about 250. So I was suggesting that $250 move was going to sort of ensue after the breakout sometime somewhere around 1520. So that's about 1770. So that takes you up to 1770, which is close to this psychologically important 1800 level. So my projection was that we would move in towards the high 1700s or 1800 price range. And of course, if I now remove this block, you can see that that's exactly what happened. Price got up to this point here. In fact, just highlight it. Try to. These are monthly candles. Each one of these candles represents a month. So if you zoom in, you'll see the price action more clearly. But this candle got up to just 1784, or thereabouts. Obviously you have to zoom in a lot closer to get the exact number, 1780. So to within a few dollars of the target. So the height of that flagpole projected and gave us the exact target for price to start to pause, and it did pause, not for long though, because the next month it shot up towards the 2000 level. In fact, went beyond the 2000 level before deciding that we need a bit of a pullback and correction. So my whole point is that by knowing that we've formed a base, and we're forming a base because we're at a cyclical low, then you know that the whole process of bottoming, price bottoming, is behind us, and the moves now are going to be in an upward direction. That's a very clear base information. You know, you don't really need to be a chart expert to realize or to perhaps understand that as we're at this cyclical low, price is bottoming, and when it breaks out of that, it's psychologically important because traders realize what's happening and money flows into the sector, and as money flows into the sector, prices rise. And of course, as prices rise, it attracts more attention and more money flows into the sector, and the whole thing is self-perpetuating. Traders aren't daft, of course. They realize when things get a little bit technically overbought and you've reached your target levels and price needs to come back down again. If it doesn't, you're in a blow-off phase, and you don't really want to be in a blow-off phase until the end of the bull market, which isn't going to be in 2023, 2024, by the way. That's just an 8-year cycle low. The end of this bull market is going to be in the late 2020s, somewhere up here. So although price I'm expecting it to accelerate to the upside in the short term as we pull out of this correction, and then back down to the 2024 low, which should be a short sharp low, a bit like the 2008 low, and then we're going to see price accelerating to the upside into the late 2020s as the results of all this crazy stimulus and money creation really starts to kick in. So something's going to happen, something not good is going to happen to bring about the 8-year cycle low, much like the crash in 2008. How it's going to play out exactly, obviously I don't have a crystal ball, but something's going to happen that brings about those lows, and then we take off really, really rapidly to the upside, and that's where we see some crazy, or the possibility of some crazy valuations for gold and silver and other commodities. So I'll leave it there for now. Hopefully that's given you a flavour of how and why technical chart analysis can put you on the right side of the trade. And thank you very much for listening.